Most people think investing is about intelligence. It is not. If intelligence created wealth, the highest paid professors in economics would be billionaires. And they are not. If information created wealth, then in an age where every financial strategy is one search away, poverty would have disappeared decades ago. But it hasn't. This is the first fracture in the illusion, because investing is not a knowledge game. It is a system game. And most people are unknowingly operating inside a system designed to keep their capital small, their risks emotional, and their decisions reactive. This is the trap. You were taught to see money as something you earn, then spend, then maybe save what's left. But millionaires do not see money that way. To them, money is not income. It is not comfort. It is not even security. It is fuel. And like any fuel system, whether in physics, biology, or economics, the outcome is determined not by how much fuel you have, but by how efficiently the system converts that fuel into motion. Right now, your financial life is likely operating like a leaking engine. Energy goes in, effort goes in, time goes in, but very little velocity comes out, and you feel it. That quiet anxiety when you realize your income increases, but your net worth doesn't move at the same speed. The subtle pressure when you see others getting ahead, while you're working just as hard, if not harder. The invisible ceiling that seems to reset every time you get close to breaking through. This is not random. This is structural. Millionaires are not playing the same game as everyone else. They are operating on a completely different financial architecture, one that most people never even realize exists. And here is where it becomes uncomfortable. Because once you see this architecture, you can no longer blame luck, background, or timing. You're forced to confront something deeper. You were never taught how the system actually works. You were trained to participate, not to control. This is why most people invest too late, exit too early, chase trends, fear volatility, and mistake activity for progress. They are reacting inside the system, while millionaires are positioning outside of it. And that difference changes everything. Because investing like a millionaire is not about copying what they buy. It is about understanding how they see, how they filter risk, how they deploy capital, how they wait, how they ignore noise, and most importantly, how they build structures that make money grow without requiring constant attention. But there is a deeper layer, a hidden mechanism beneath strategy, beneath assets, beneath numbers. A psychological operating system that quietly dictates every financial decision you make, often without your awareness. And unless that system is rewired, no strategy will save you. Not stocks, not crypto, not real estate, not business. Because you will sabotage the outcome long before it compounds. So the real question is not, how do you invest? The real question is, who are you when you invest? Because the person you are right now is producing the financial results you currently have. And that identity is programmable, but only if you understand the system behind it. In the next section, we're going to dismantle the invisible architecture controlling your financial outcomes, the structure that quietly shapes how money flows in your life, and why most people remain trapped inside it without ever realizing. And once you see it, you won't be able to unsee it. There is a structure beneath your financial life that you have never been shown. Not because it is hidden, but because it is normalized. From the moment you begin earning, you're placed into a predefined flow. Income enters, expenses expand, and whatever remains is labeled as savings. This flow feels natural, responsible even. But this is where the structure reveals itself. Because this system was never designed to create wealth. It was designed to sustain participation. You are rewarded for consistency, not for leverage. You are encouraged to stabilize, not to scale. And most importantly, you're trained to prioritize consumption cycles over capital cycles. This is the invisible architecture. And once you see it, something uncomfortable becomes clear. Your financial behavior is not entirely your own. It has been shaped, quietly, persistently, by the environment around you. Think about it. Why does income feel like the primary goal instead of ownership? Why does spending feel like progress instead of leakage? Why does investing feel risky, while long-term stagnation feels safe? These are not logical conclusions. They are conditioned responses. This is why two people can earn the same amount of money, and one builds wealth while the other remains stuck in financial tension for decades. The difference is not discipline. It is structure. Millionaires do not rely on income alone because they understand a fundamental principle. Income is linear. Wealth is exponential. And linear systems, by definition, cannot produce exponential outcomes. This is where most people unknowingly limit themselves. They try to solve a structural problem with behavioral effort. They work harder. They budget tighter. They optimize expenses. But they remain inside the same system, expecting a different result. This is the trap. Because effort inside a flawed structure only reinforces the limitation. It does not break it. Now, here is the shift. Millionaires do not ask, "How can I earn more?" They ask, "How is my money behaving when I am not involved?" This single question changes the entire architecture because it redirects focus from activity to structure, from effort to design, from income to capital flow. And once you begin to see money as something that must move, multiply, and return, rather than sit, shrink, and be spent, you begin to step outside the default system. But stepping outside creates friction, because everything around you is built to pull you back in. Your peers normalize spending patterns. Your environment reinforces lifestyle upgrades. Your social feedback rewards visible consumption, not invisible accumulation. And slowly, without realizing it, your financial decisions become less about logic and more about alignment. Alignment with expectations. Alignment with identity. Alignment with what feels normal. This is why most people never escape. Not because they lack intelligence, but because they are surrounded by a system that continuously recalibrates their behavior back to baseline. This is where personal shame enters the equation. People look at their finances and think, "I should be doing better. I make enough, so why am I not getting ahead? I must be doing something wrong." But this is a misdiagnosis, because the issue is not a lack of effort. It is exposure to a system that was never designed to produce the outcome you want. This removes something critical, blame, and replaces it with something far more powerful, responsibility. Not responsibility in the sense of self-criticism, but responsibility in the sense of awareness. Because once you see the structure, you gain the ability to redesign it. And redesign always begins with one shift. You stop thinking like a participant and start thinking like an architect. This is the first cognitive transition. Instead of asking, "Where is my money going?" you begin asking, "What system is my money operating inside?" Instead of reacting to expenses, you begin engineering flows. Instead of measuring success by income, you begin measuring it by asset growth. And slowly, almost imperceptibly at first, your financial identity begins to separate from the default path. But here is where tension increases, because awareness creates discomfort. You begin to notice inefficiencies everywhere. You start questioning decisions that once felt normal. You feel the pull between short-term gratification and long-term positioning. And this is where most people retreat. They see the system, but they do not stay outside of it long enough to benefit. Because stepping outside requires something deeper than knowledge. It requires behavioral control under pressure. And this is where the next layer of the system begins to surface. Because even if you understand the architecture, even if you see the flows, even if you begin to redesign your financial structure, there is still something that will quietly pull you back into the trap. Not externally, but internally. Your behavior, your impulses, your emotional responses to money. In the next section, we're going to break down the psychological traps that sabotage investors before they ever reach momentum, the hidden patterns of behavior that cause people to buy at the wrong time, sell at the worst moment, and confuse movement with progress. And once you see these patterns, you'll recognize them instantly. Not in others, in yourself. There is a moment, quiet, almost invisible, where logic loses control. It does not happen when you're calm. It happens when money is involved. Because money is not neutral. It is emotional, symbolic, and deeply tied to identity. And this is where the structure tightens. Because even if you understand the architecture, even if you begin to redesign your system, your behavior can still collapse everything. This is the second trap. You do not lose in investing because you lack strategy. You lose because you react. And reaction is not random. It follows patterns. Predictable, repeatable, and dangerously consistent patterns that behavioral economists have studied for decades. Patterns that explain why people buy at the top, sell at the bottom, and feel confident at exactly the wrong time. This is where the system reveals its psychological layer. Let's begin with the first distortion: perception of risk. Most people believe risk is about volatility, prices going up and down. But that is not how millionaires define it. To them, risk is not fluctuation. Risk is the probability of permanent loss of capital. This is a critical distinction, because when you confuse volatility with risk, you begin to fear the wrong things and trust the wrong things. You panic when prices drop, seeing danger where there may be opportunity. And you feel safe when prices rise, trusting momentum that may already be exhausted. This inversion is where wealth quietly transfers, from the reactive to the positioned. This is the trap. Now layer in emotion. When markets rise, your brain releases signals associated with reward, anticipation, excitement, validation. You begin to feel intelligent, decisive, early. But you're not early. You're visible. And visibility is where crowds gather. This is why trends feel so convincing, because by the time something looks obvious, it has already moved. And when you finally enter, you're not investing. You're confirming what everyone else already believes. And this is where the structure tightens further, because the moment you invest based on emotional confirmation, your exit becomes emotional as well. When prices drop, fear replaces confidence, doubt replaces clarity, and suddenly, the long-term strategy you believed in becomes negotiable. This is where most people break. Not because the asset failed, but because their emotional tolerance collapsed before the thesis could play out. This is known as loss aversion, the psychological tendency to feel losses more intensely than gains, and it is powerful enough to override logic completely. A 10% loss does not feel like a 10% loss. It feels like failure. And failure triggers urgency. Urgency triggers action. And action, under emotional pressure, is rarely strategic. This is why people sell at the worst possible time, not because they want to, but because they need relief. Relief from uncertainty. Relief from discomfort. Relief from the internal tension of watching their capital shrink. And in that moment, they exchange long-term potential for short-term emotional stability. This is the cost. Now consider the opposite. When an investment performs well, a different distortion emerges. Overconfidence. You begin to attribute success to skill rather than environment. You believe you understood something others didn't. You increase position sizes. You take on more risk. You compress your decision-making time. And slowly, without realizing it, you move from strategy to speculation. This is where intelligent people become vulnerable, because intelligence amplifies justification. You can rationalize poor decisions with convincing logic. You can explain away risk. You can construct narratives that make your behavior feel strategic, even when it is not. This is why knowledge alone is insufficient, because knowledge does not neutralize emotion. It often enhances it. Now layer in identity. This is where the system becomes deeply personal. Because your financial behavior is not just about money, it is about who you believe you are. If you see yourself as someone who deserves to enjoy life now, you will unconsciously prioritize consumption over investment. If you see yourself as not good with money, you will avoid complexity and default to simplicity, even when it limits your growth. If you associate wealth with risk, greed, or instability, you will subconsciously resist the very actions required to build it. This is identity-based self-sabotage, and it operates quietly. You will not notice it in the moment. You will only see its effects over time. Repeated patterns, missed opportunities, decisions that feel right in the moment, but produce the same outcome again and again. This is the deeper trap, because you are not just managing money. You're managing your relationship with money, and that relationship is shaped by experiences, environment, and internal narratives that were formed long before you ever made your first investment. Now add one final layer: status illusion. Modern financial behavior is heavily influenced by visibility. What you can see feels real. What you cannot see feels distant. This is why people upgrade their lifestyle before they upgrade their asset base. Because consumption is visible. It generates feedback, recognition, validation. But investing is invisible. There is no immediate reward, no applause, no social reinforcement, only delayed outcomes. And in a world conditioned for instant feedback, delayed gratification feels like loss. This is why most people never sustain long-term investing behavior. Not because it does not work, but because it does not feel rewarding in the short term. This is where the system reaches its most powerful form. It aligns emotional reward with behaviors that reduce wealth and delays reward for behaviors that build it. So unless you consciously reverse this alignment, you will continue to act against your own financial interests while believing you're making rational decisions. This is the mechanism, and once you see it, the pattern becomes impossible to ignore. You will begin to notice how emotions influence timing, how identity shapes allocation, how social pressure distorts perception, how internal narratives quietly dictate external outcomes. But awareness alone is not enough, because the next layer is unforgiving. It does not care about your psychology. It does not care about your intentions. It operates on pure mathematics. And if you do not understand it, you will underestimate what is possible. Or worse, you will sabotage compounding before it ever has a chance to work. In the next section, we break into the numbers, not surface-level explanations, but the actual mechanics of how wealth grows, accelerates, and eventually becomes self-sustaining. Because once you see the math, you will understand why small decisions today carry exponential consequences later, and why most people quit right before everything changes. Wealth is often romanticized as a product of hustle, intuition, or market timing. But at its core, it is mathematics. Not simple arithmetic, but a system of compounding, thresholds, and asymmetry that most investors never fully grasp. And this is where the illusion breaks for most people. Let's start with compounding. Not the vague idea of interest on interest, but real structural compounding applied to capital over time. Imagine you have $10,000. You invest it with a modest 10% annual return. In 1 year, it becomes $11,000. Simple. But the key is what happens in year 20. That $10,000 has now grown to over $67,000, not because the strategy changed, but because the system amplified time. Most people underestimate time's multiplier effect. They see $10,000 turning into $11,000 in a year and declare it insignificant. But they ignore the exponential nature of repeated cycles. The millionaire sees this differently. The first $10,000 is not about the immediate return. It is about initiating a machine that grows autonomously. And every addition to that capital, even modest, feeds into the same mechanism, accelerating wealth velocity. Wealth velocity is the concept that separates the linear from the exponential. Your average investor treats each dollar like a static tool. Millionaires treat each dollar as an engine. Capital deployed strategically accelerates, multiplies, and generates new capital streams. This is why a $100,000 investment structured correctly can produce more long-term value than a $500,000 investment structured poorly. The math does not lie. Execution does. Next, consider thresholds. There are invisible thresholds where compounding truly ignites. In investing, it is not about hitting a number. It is about crossing the point where returns begin to feed themselves faster than inputs. For example, $50,000 invested across diversified assets with moderate risk might grow steadily, but $100,000 invested in the same system begins to create meaningful secondary effects. Access to opportunities, better rates, higher leverage options. Each threshold opens doors to asymmetrical outcomes that the average investor cannot reach. This is why the timing of capital deployment matters as much as the deployment itself. But here is a subtle tension few understand. Compounding requires consistency under emotional pressure. Losses, volatility, and short-term setbacks feel catastrophic, but in reality, they are part of the process. Millionaires do not ignore losses. They understand them mathematically. A 10% drawdown in a structured system is a minor deviation, not a failure. Most investors panic and exit, permanently interrupting the compounding engine they barely started. Now, let's examine the escalation effect. Imagine an investor who starts with $50,000, adding $10,000 each year at 10% annual growth. Over 20 years, that person's capital does not simply grow by linear additions plus simple interest. Every annual contribution compounds alongside the previous contributions, creating a snowball effect where year 15 feels like progress, year 18 feels like acceleration, and by year 20, growth appears explosive. even though the process was entirely disciplined and incremental. Numbers do not lie, but most people misread the signals. They see early years as slow and assume failure. They exit too soon. They confuse short-term volatility with system failure, and in doing so, they abandon the very mechanism that could make them wealthy. This is the mathematical manifestation of the psychological traps we discussed earlier. Fear and impatience directly interrupt compounding. Finally, there is capital allocation. Wealth is not just about growing money. It is about positioning it for multiple layers of compounding. A millionaire divides capital across strategies designed to amplify each other. Some money works in low-risk systems for slow, steady growth. Other money works in optionality strategies with asymmetrical upside. And some is allocated to skill stacking, creating returns that compound not just financially, but intellectually and operationally. Each layer interacts. Each layer accelerates the others. This is why small differences in allocation create enormous disparities over time. Two investors with identical capital can produce entirely different outcomes based purely on system design, threshold management, and compounding discipline. One follows the linear path. One follows the exponential. And here is the open loop. Most people focus on the first layer of compounding, returns on assets. They miss the second, third, and fourth layers, capital thresholds, wealth velocity, optionality, and skill leverage. The difference between a modest nest egg and a self-sustaining fortune is not luck. It is design, execution, layering, and patience. In the next section, we will confront a paradox: why intelligent, disciplined people often fail despite knowing these principles. It is not ignorance. It is not lack of strategy. It is environmental pressure, lifestyle inflation, and the subtle economics of decision fatigue, all forces that act silently against wealth accumulation. Once you see this, you will understand why mastery of the system is as much psychological as mathematical. Intelligence alone does not produce wealth. In fact, in many cases, it increases the risk of failure. This is counterintuitive, but it is one of the most consistent patterns across history. Highly capable individuals earn more, understand strategy, and have access to more resources, but still fail to accumulate meaningful capital. Why? Because wealth is not only about what you know, it is about what you allow yourself to do in the environment you inhabit. First, consider social programming. From childhood, you're conditioned to conform, to belong, to prioritize acceptance over experimentation. You internalize norms about consumption, achievement, and success. These norms often favor visible outcomes: a new car, a bigger apartment, the latest gadget. Meanwhile, the invisible system of wealth accumulation, the patient compounding, the delayed gratification, the invisible asset flows, is rarely celebrated. And because your social identity aligns with norms, it exerts constant pressure. You may know better, but the environment pulls you back toward default behaviors. Next, lifestyle inflation. As income rises, expenses tend to rise even faster. This is why many professionals earn six figures yet feel trapped. Their perceived progress increases, but their net worth stagnates. They are caught in a psychological treadmill where each raise triggers an upgrade in lifestyle, creating the illusion of wealth while actual financial leverage diminishes. The higher your income, the stronger the gravitational pull of lifestyle expectations, and the harder it is to resist. Now, layer in decision fatigue. Every day, you make hundreds of micro-decisions with financial implications. Some are trivial, like choosing a coffee. Others are more consequential, like allocating capital. Each choice depletes your cognitive resources. Over time, your capacity for strategic thinking diminishes. This is why intelligent individuals who can analyze complex scenarios still make poor choices under sustained pressure. They are not lacking ability. They are systematically drained. But the subtlest force is psychological tension. The intelligent investor often overthinks. They analyze endlessly, seeking certainty in an uncertain world. Meanwhile, opportunity passes. Timing windows close. Compounding is delayed. And here lies the cruel irony. The very traits that make someone smart, discipline, attention to detail, foresight, can be weaponized by the environment to keep them inactive, reactive, or overstretched. Consider the external pressures. Family expectations, peer comparisons, and societal markers of success all push you toward consumption. Your internal signals, fear of missing out, desire for approval, magnify these pressures. Even the best-laid plans are at risk because every day, subtle cues encourage deviation from strategic behavior. This is why raw intelligence is insufficient. Wealth requires resilience against these forces, not just the ability to understand them. Now examine emotional velocity. Most people experience money in bursts: the thrill of earning, the panic of a loss, the satisfaction of spending. These emotional oscillations lead to inconsistent actions: investing late, cashing out early, chasing trends, or avoiding risk entirely. Intelligence alone cannot override these emotional impulses. They require disciplined systems and identity realignment. And yet, the paradox remains. Those who overcome these pressures rarely do so because they are smarter. They succeed because they think in systems, not events. They build architecture that anticipates environmental friction. They structure capital flows to minimize behavioral interference. They design rules that operate regardless of emotion. Here is the critical insight. Intelligence gives you knowledge. Strategy gives you a plan. Environment gives you pressure. But compounding success, the creation of lasting wealth, requires mastery over all three simultaneously. Fail in one, and the others will fail you. Most people never realize this because they focus on the wrong metrics. They monitor income instead of assets. They measure effort instead of leverage. They seek validation instead of alignment. And by the time they recognize the gap, momentum is lost and compounding is delayed. This is the subtle architecture of failure. It is invisible, relentless, and personal. And it is what separates the almost rich from the millionaires. The next section will reveal the antidote, a step-by-step strategic blueprint for wealth. This is where theory transforms into structure, where the abstract principles of compounding, behavior, and psychology converge into a tangible system you can implement. And once you see it, you will understand how millionaires translate strategy into action consistently, while most people remain trapped in cycles of near success and near failure. Building wealth like a millionaire is not a matter of luck, timing, or chasing trends. It is a deliberate architecture, a system designed to convert capital, time, and skill into self-sustaining growth. This is where strategy transforms into tangible structure. And unlike ordinary advice, this blueprint is precise, layered, and psychologically engineered to operate even when emotions fluctuate. Step 1. Capital segmentation. Millionaires never treat all money the same. They divide capital into distinct categories, each with its own purpose and risk profile. One portion is reserved for liquidity, short-term access without jeopardizing long-term growth. Another is allocated to core assets that compound steadily, often in low to moderate risk vehicles. A third is assigned to optionality, high upside opportunities that could dramatically accelerate net worth if realized. Each segment has rules, thresholds, and boundaries. The genius of this structure is that it isolates risk while maximizing potential growth. Step 2. Asset acquisition logic. Wealth is not about chasing trends or hot investments. It is about acquiring asymmetric assets, investments where the potential upside outweighs the downside, where the system favors patience over impulse. Real estate is not valuable because it is expensive. It is valuable when it generates cash flow, appreciates predictably, and compounds through leverage. Stocks are not valuable because they are popular. They are valuable when chosen for underlying cash-generating power and market inefficiency. Millionaires see assets as systems, not symbols. Step 3. Risk mitigation structure. Risk is misunderstood by most investors. They assume diversification is enough, or that insurance alone provides protection. Millionaires design for survival under stress. They structure portfolios with uncorrelated assets, hedge when necessary, and maintain strategic liquidity. They understand that exposure is inevitable, but collapse is optional. By engineering the portfolio for durability, they survive volatility and even profit from it. Step 4. Skill stacking. Money alone does not generate mastery. Millionaires accumulate complementary skills that increase the productivity of capital. Negotiation, legal literacy, operational insight, and strategic networking are all forms of leverage. Each skill compounds alongside capital, amplifying returns and opening access to opportunities unavailable to those who rely solely on money. Wealth is multidimensional: financial, intellectual, operational. Neglect any dimension, and the system weakens. Step 5. Cash flow architecture. Assets are not wealth if they do not generate ongoing inflow. Millionaires structure investments to produce multiple layers of cash flow: passive income, interest, dividends, royalties, business earnings. These inflows are reinvested according to the capital segmentation plan. The system converts time into motion, turning static assets into dynamic engines. Cash flow is not for consumption. It is fuel for further growth. Step 6. Long-term asymmetry thinking. Millionaires always think in decades, not quarters. They seek situations where the long-term payoff far exceeds short-term volatility. They understand optionality. Small, calculated sacrifices today yield outsized rewards tomorrow. A temporary drawdown does not induce panic because the system is built to capture cumulative advantage over time. They operate with patience, not urgency. Step 7. Iteration and feedback. Strategy without adaptation decays. Millionaires constantly evaluate outcomes, refine allocation, and respond to structural changes, not emotionally, but systematically. They measure performance relative to compounding velocity, not vanity metrics like rank or portfolio size at a single point in time. The system is designed to evolve without abandoning discipline. Step 8. Behavioral containment. No blueprint works if human impulses sabotage it. Millionaires embed rules into the architecture to override emotional decision-making. Predefined thresholds trigger action, not fear. Exit strategies are coded before entry. Allocation ratios are fixed to limit overexposure. This is why they can act decisively when others panic and remain patient when others chase momentum. Finally, Step 9. Alignment with identity. Systems fail when they contradict self-perception. Millionaires cultivate a financial identity that aligns with disciplined execution, delayed gratification, and risk-aware positioning. Every decision reinforces this identity, producing a feedback loop. Identity shapes behavior, behavior reinforces identity, and the system compounds both capital and self-concept simultaneously. This blueprint is not theoretical. It is a living system, designed to operate independently of short-term outcomes, market hysteria, and social pressure. It converts knowledge into structure, behavior into flow, and patience into exponential growth. Yet, even the most elegantly designed system can be accelerated. And this is the next frontier, the acceleration phase. It is here that capital velocity multiplies, optionality expands, and wealth moves from linear compounding to geometric transformation. Millionaires do not wait for decades to see results. They create dual engines that amplify each other and exploit strategic timing windows. In the next section, we will deconstruct this acceleration phase and reveal how the combination of income and assets creates a feedback loop that most people never access. Understanding this is the key to moving from slow growth to wealth in motion. Once the foundation is in place, wealth does not grow linearly, it accelerates. This is the point where the system transitions from steady compounding to exponential compounding, and where millionaires create layers of leverage that most investors never even see. The acceleration phase is not accidental. It is deliberate. It relies on dual engines, optionality, and the precise timing of capital deployment. The first engine is income. This is not just your salary or business profit. It is predictable, repeatable inflow that fuels the other systems. Income alone will not make you wealthy, but it is essential as a base. It provides the fuel to invest, the safety to take calculated risks, and the foundation for scaling assets without jeopardizing survival. The second engine is assets. These are not passive holdings. They are operational engines, producing returns, optionality, and reinvestable capital. Each asset interacts with the other. One generates cash flow, another provides asymmetric upside, and a third creates strategic leverage. When combined with income, these assets create a feedback loop where money generates money, faster than human effort alone could achieve. Optionality is the multiplier. It is the hidden asymmetry in every system. Millionaires do not put all capital into a single path. They maintain positions in multiple domains, each with the potential for outsized returns. Optionality is not speculation. It is structured opportunity. It ensures that when unexpected events occur, market shifts, technological disruption, economic cycles, the system benefits rather than collapses. Leverage is carefully controlled. There is a critical distinction between strategic leverage and leverage abuse. Strategic leverage amplifies growth without threatening the core system. It allows small capital to access opportunities normally reserved for larger players. Leverage abuse, by contrast, exposes the system to catastrophic failure. Millionaires know where the tipping points are. They calibrate exposure to risk, timing, and environment, ensuring that acceleration does not come at the cost of collapse. Timing windows are often overlooked but are pivotal. Markets and opportunities do not operate in continuous time. They appear in discrete, often unpredictable windows. Millionaires train to recognize structural signals, economic cycles, technological adoption curves, policy shifts. They do not chase trends. They position ahead of them. By doing so, they enter optionality opportunities at maximum asymmetry, capturing outsized gains while limiting downside. The interaction of these engines is where the system becomes truly self-reinforcing. Income feeds assets. Assets amplify cash flow. Optionality increases upside probability. Leverage magnifies effect. Timing determines efficiency. Each layer compounds the others, producing acceleration that is perceptible only when viewed over multiple cycles. But acceleration is not purely mechanical. It is psychological. Sustaining dual engines requires disciplined detachment. Emotional impulses, fear, greed, envy, can destroy momentum. Millionaires engineer the system to operate with minimal emotional interference. Rules are coded, exit strategies predefined, and capital allocated according to long-term architecture, not short-term stimulus. Consider the hidden effect. As the system accelerates, decision-making becomes proactive rather than reactive. Opportunities that once seemed inaccessible now become visible. Risk that once felt threatening now appears manageable. Velocity generates confidence, and confidence produces clarity, which in turn allows for even greater optionality. This is how acceleration becomes exponential rather than linear. Yet, there is a subtle danger. Acceleration can create illusion. Rapid growth can be misinterpreted as invulnerability. Success can induce complacency. Without identity alignment, internal psychological recalibration, the same forces that produce velocity can destabilize the system. This is why acceleration alone is not enough. The mind must evolve alongside the portfolio. In the next section, we will explore identity evolution, the internal rewiring that allows delayed gratification, detachment from short-term outcomes, and strategic thinking on decades rather than months. Without this transformation, acceleration is temporary. With it, acceleration becomes sustainable, producing not just wealth, but the freedom to wield it effectively. Acceleration is powerful, but it is nothing without internal alignment. Wealth is not just external, it is an extension of who you are. The moment your financial systems begin to amplify, your identity is tested. Every latent belief, every emotional impulse, every subconscious narrative about money surfaces. This is why the next phase, identity evolution, is not optional, it is mandatory. The first shift is psychological rewiring. Most investors operate on immediate gratification cycles, reward now, consequences later. Millionaires flip this script. They internalize the principle that delayed gratification is not a sacrifice. It is an investment in self. Choosing to reinvest instead of consume, to wait instead of react, to think in decades rather than months, rewires neural pathways. The brain begins to perceive patience as power and restraint as leverage. This leads to strategic detachment. Emotional reactions are the enemy of velocity. When capital accelerates, the impulse to micromanage grows. People become reactive to minor fluctuations, chasing trends, and overcomplicating decisions. Identity evolution creates the psychological buffer. Decisions are made from structural rules, not emotional states. You no longer need to feel safe to act strategically. You act because the system dictates action. Next is the cultivation of long-term vision. Most humans are trained to operate in quarterly cycles, performance reviews, budgets, short-term metrics. Millionaires think in decades. They visualize capital growth over 20, 30, 40 years. Each decision is assessed for how it compounds within the system, how it interacts with other assets, and how it strengthens the architecture over time. This perspective transforms small actions into exponential leverage. Behavioral consistency becomes identity. Every strategic choice, allocating capital, reinvesting returns, diversifying assets, is embedded in self-perception. I am a multiplier. I am patient. I am positioned. These internal narratives align decisions with the system. When identity and structure synchronize, discipline becomes effortless. Action is no longer a battle, it is an automatic response to internalized principles. Identity evolution also addresses risk tolerance. Fear, loss aversion, and overconfidence are not removed. They are recalibrated. The evolved investor perceives risk structurally, not emotionally. Losses are data points. Drawdowns are opportunities. Gains are reinvested engines, not validation. The emotional volatility that derails most investors is transformed into a steady feedback loop, reinforcing disciplined execution. Finally, identity evolution instills resilience against environmental pressures. Lifestyle inflation, peer validation, and societal comparison are neutralized by an internal framework that prioritizes systemic growth over superficial reward. External signals no longer dictate behavior, internal architecture does. Wealth becomes a reflection of self, not of circumstance. But evolution is iterative. It is reinforced through experience, reflection, and incremental recalibration. The mind adapts alongside the portfolio. Over time, patience becomes instinct, structure becomes habit, and identity becomes the foundation that sustains both acceleration and exponential compounding. The next section will redefine wealth itself, not as income, assets, or status, but as freedom, power, and strategic capacity. This is where the millionaire mindset transcends numbers and becomes a fully integrated life architecture. Most people define wealth as income, possessions, or status. But this is an illusion, a shallow reflection that collapses under scrutiny. True wealth is systemic, multidimensional, and deeply strategic. It is not what you have in your bank account today. It is the freedom, optionality, and control that your capital structure generates over time. Millionaires understand this distinction intuitively, and it fundamentally changes how they operate. First, freedom beyond consumption. Most people equate wealth with the ability to spend: new cars, exotic vacations, luxury items. Millionaires measure freedom differently. They measure it by autonomy. The ability to make decisions without being constrained by immediate financial pressure. The ability to pursue opportunities, experiments, or ventures without risking collapse. Consumption is a symptom. Freedom is the operating principle. Capital is deployed not for visibility, but for leverage, and leverage multiplies autonomy exponentially. Second, power beyond status. Social recognition is seductive, but it is fragile. Visibility is external, temporary, and often misaligned with long-term positioning. True power is internalized. The capacity to influence outcomes, shape markets, and make decisions insulated from societal volatility. Assets are not symbols. They are instruments of influence. Knowledge is not bragging. It is applied capability. Control is the measure of power, and the more systems you have in motion, the greater your strategic capacity. Third, wealth as resilience. This is the dimension most overlooked. The system is designed to endure shocks, cycles, and uncertainty. True wealth protects not just lifestyle but opportunity. It enables risk-taking without catastrophic consequences. It converts volatility into optionality. The millionaire sees a downturn not as loss, but as an asymmetric opening, a structural advantage hidden from those still anchored to linear thinking. Fourth, wealth as identity alignment. External measures are fleeting. Internal measures are compounding. When identity, behavior, and system converge, wealth becomes self-reinforcing. Capital grows, knowledge grows, influence grows. Patience becomes instinct. Decisions are automatic, yet strategic. The individual and the system evolve in tandem, producing outcomes that are sustainable, scalable, and resilient. Finally, wealth as legacy potential. Beyond personal freedom and strategic power lies the capacity to create systems that outlast your direct involvement. Assets can continue to grow, optionality can persist, and the framework you design can extend influence across generations. Wealth becomes a generational lever, autonomous, exponential, and insulated from individual volatility. This redefinition changes behavior instantly. When wealth is measured in freedom, influence, resilience, and legacy, consumption becomes a tactical choice, not a compulsion. Risk is evaluated structurally, not emotionally. Decisions are informed by long-term architecture rather than short-term reward. The mind aligns with the system, reinforcing the internal rules that accelerate compounding and sustain exponential growth. The next step is the final phase: closure, challenge, and ascension. We will integrate all lessons into a decisive call to action, visualizing your future self, confronting the behavioral inertia that holds most people back, and defining a framework for strategic execution that transforms knowledge, psychology, and structure into sustained wealth. Now, everything converges: the architecture, the psychology, the math, the identity. All of it points to a single truth: wealth is not given, it is designed, and the system will either serve you or continue to work against you. Ask yourself, who are you in relation to your money? Are you a participant, reacting to external pressures, chasing comfort, and validating yourself through consumption? Or are you an architect, commanding capital, mastering behavior, and leveraging systems that operate even when you do not intervene? This is the decisive question. Your answer will define whether the lessons you have absorbed remain theory or become your reality. The challenge is immediate and uncompromising. Reevaluate every decision, every allocation, every impulse. Do not defer. Do not rationalize. The invisible structures of behavior and environment will seek to pull you back to baseline. You must consciously resist. The acceleration you now understand will not wait for hesitation. Momentum favors decisiveness. Visualize your future self, patient, strategically detached, operating in a network of dual engines, skill-stacked, capital-optimized, identity-aligned. Every financial move is deliberate, every risk calculated, every system functioning in harmony. The life you imagine, freedom, optionality, resilience, influence, is a direct result of actions taken now. Your future self is waiting for your commitment today. Here is the call to action. Codify your capital. Engineer your flows. Rewire your identity. Build optionality. Embrace acceleration. Let delayed gratification become instinct. Do not negotiate with emotion. Do not compromise with comfort. Every decision, no matter how small, compounds into the architecture of your wealth. Remember this: once internalized, it will never leave you. The system responds to the person you become, not the one you were. Master your identity. Master your behavior. Master the architecture. And you will not merely accumulate wealth. You will generate freedom, influence, and resilience that multiply far beyond what linear effort could ever achieve. The structure has been revealed. The blueprint is clear. The acceleration is ready. Your identity is the final lever. The question now is simple. Will you act, or will you remain a participant in someone else's design? Wealth waits for the decisive. Time waits for no one. Step forward, architect of your own fortune.